Okay, so for today's lesson, right, we are going to look into tutorial 2. The topic is called the macro environment of the business, but the main focus is on the calculation of the GDP, a bit more of formula this time, not like the simple one that as we learned last week, but today's one a bit more detailed, and that is the thing that you will be assessed in your midterms as well. Only midterms. Okay. So you may want to put more attention into the formula that you're going to come across later on. So for today's lesson, right, the focus is still on GDP. So before we look into any of the tutorial question, as you can see on my screen right now, you scroll down a bit. Okay, I want to show you some notes. The notes that I provided to you here as a quick recap before we look into the questions. So since we talk about GDP, right, the first thing that you should know is how do you define GDP? There are 4 key terms that you need to use when you were to define GDP, in which I highlighted in yellow. So GDP refers to the market value, like what I showed you in the previous lesson. Market value means you use the price times the quantity, right? So that's what you learned in the previous lesson. So that's the first term, okay? Market value of all final goods and services. So we are referring to the final goods and services. That means completed products, okay? Produced in a country, that means we look into a country itself in a given time period, that means in a year, okay? So therefore, with the use of GDP, right, I can see what is the country's output, okay, overall. So with this, right, with this information, I can use to assess the country's performance, okay, and also to compare the standard living across the countries over time. So I can compare to see whether there is any improvement from year to year or not, and see whether there's an improvement as compared to other countries or not. So that's how we use GDP in our daily life as well. Okay, so remember GDP looks into the value, okay, the value of the country's outputs. Okay, so there are 3 approaches in measuring GDP. So the first one is called expenditure approach. Okay, so how do we have all these approach thing coming out? In the previous lesson, I remember I showed you one simple cartoon thing, the page. I show you that the person is a baker. Okay, so he want to buy a candle from a lady. So he pay the money to the lady, and lady give him the candle. Okay, so once the lady has the money, she used the money to buy meat from another person. Okay, so you can see that at the end of the day, right, whatever that's being produced will equal to whatever amount that will be spent, and that also equals to the amount that they earn. So this is why output equals to the expenditure and equals to the income. So from that diagram that I showed you in the previous lesson, you can see 3 terms here. Output equals to income, income equals to expenditure. That means we assume theoretically, okay, these 3 should equal to each other, but of course it doesn't happen in real life. Okay, so it's theory. Now, because of that 3 terms, therefore we have these 3 approach over here. The first one is expenditure approach. That means it takes into account of the total spending in the economy. Okay, total spending. So whatever we spend is being recorded. Okay, so that refers to the aggregate demand. Aggregate demand, the word aggregate means total. Okay, the word total means aggregate. Okay, so I want you to remember one key terms. So since it refers to aggregate demand, okay, is comprising of consumption, C, investment, I, government spending, G, and net exports, NX. Okay, NX means net exports. So one important tips, aggregate demand equals to the 4 components. It is the combination of consumption, investment, government spending, and net exports. Yeah, this is important. You are going to come across this again and again later on. Okay, the next approach is called income approach. Income approach looks into the net domestic income at the factor cost. That means what? That means I look into all factor incomes. Okay, that means like for example, wages of the workers, corporate profits, proprietor's income, net interest, rental, anything that is being earned by the factors of production. As long as it's about income, it's being recorded over here, except transfer payment. Now, what is transfer payment? Transfer payments are like the financial assistance by the government. Like for example, let's say you are very poor and therefore you are eligible for certain financial assistance by the government. Therefore, you claim for the financial assistance, and that is what I call as transfer payments. It is not considered as an income under here because it's not something that you earn. It's like an assistance to you because you are poor, so therefore they give it to you. Or if you are retired, they give it. You don't use the word subsidy. Use financial assistance because it can mean very differently. Subsidy is usually being given to the producers directly. Transfer payment here is given to households like us. Like for example, you have retired or you are poor, below a certain level of the income, therefore you are eligible for it. Subsidies is where government gives to the producers directly. And the purpose of giving subsidy is to reduce the cost and increase the output. So a bit different, okay? So therefore, transfer payments are not considered as income because that's not what you earn. And it's not because something that you produce and therefore you get the income. So no. Okay, so transfer payments are being excluded. Okay, so therefore that is income approach. You look into the income of all the factors of production. Okay, all factors income. The next approach is output approach. Output approach, that means I look into the value of the final goods and services, or by looking into the added value of the output. That means if I want to use output approach, I have two ways for me to compute output approach. One way is just to look into the value of the final goods and services, the final products, or I look into the value added. I cannot choose both because it will lead to double counting. Now, what do you mean by double counting? Very simple. Let's have a look into a scenario here. Okay, let's say this is an apple juice. Okay, let's say this is apple juice. Okay, let's say this apple juice is $3, for example, $3. Sorry, this apple juice, let's say it's $5. Let's say assuming it's $5. Okay, let's say it's $5. Okay, so if I take this apple juice is $5, right? Okay, now let's say there's apple. Okay, there's apple here. So apple is $2. Okay, so you see, if let's say now this apple is being used to produce apple juice, right? Okay, apple is being used to produce apple juice. What happened is if I record it, looking into these two items, I take this 2 ringgit and 5 ringgit is inaccurate already. Why? Because this 2 ringgit is already being used to produce this apple juice already. I shouldn't take this 2 ringgit actually. Okay, I should just take this 5 ringgit. This is the final output. The apple is just an intermediate, like the raw materials that are used to produce apple juice. So if today I do not take only the final goods and services, there will be double counting because I will take this 2 ringgit and 5 ringgit, it becomes 7 ringgit. So it will become 7 ringgit if I take both of the items. So it's inaccurate already because the apple is being used to produce this apple juice already. Okay, so therefore, we should only take the final value of the goods and services, or we take the added value. So that means how? That means I use the color. That's a black color. So let's say I take apple, 2 ringgit. Yes. Okay, let's say if I choose to take apple, 2 ringgit. Yes, I take this one. Okay. And then after that, apple is being used to produce apple juice. From 2 ringgit to 5 ringgit, in between is how much of the added value? Is 3. Yeah, 3. So I take the added value here. So 2 plus 3 equals 5. So then there will not be any double counting. That means what? That means I either take the final value of final goods and services. Okay, the final goods and services, or I take into account of the added value here. Okay, added value here to avoid what? To avoid double counting. Because if I go and take this 2 here, 2 and 5, it becomes 7. There's double counting already because the apple is already inside here. So I shouldn't even take the 2 ringgit. Okay, so therefore, this is why we say that if you want to use output approach, it's either you look into the final goods and services or the added value. Okay. Yeah. So these are the three approach. But of course, in reality, there will be some discrepancy. So it's not always three of them equal to each other. So in exam, midterm, how do you decide which approach to choose? So let's say they will ask you to calculate the GDP, asking you to use one of the approach. They didn't tell you which one. So you need to decide based on what kind of information that's been given to you. Okay, for example, I give you the table. The table has consumption, investment, net exports. So you know that that is expenditure approach. If I give you the values about the income of the people, the rental, okay, the profits of the company, then that is income approach. So you look into the table and decide which approach that you should proceed. Okay, so that's the first part over here. Now, is GDP always good? GDP is not always good because GDPs, right, they only look into the value of the outputs of the country. It only tells you how much the country is producing. And yes, we are using that to assume how well the country is doing. But there are drawbacks, there are limitations. These are the limitations. For example, GDP, right, doesn't look into the healthcare, the life expectancy of people, the living quality. They don't look into all this. The country could have a very high GDP, but end up the people are not doing good. Okay, the rich are really rich, poor are really poor, wide wealth inequality. Okay, and the countries could have a very high GDP, but there's no freedom of speech. Okay, and they're using up the resources in a very fast manner. Okay, so therefore all these are being excluded. Like even maybe the countries people are doing a lot of illegal stuff, but their GDP is still high. So you see, all these things are not being taken into account. So therefore, the quality of life is being ignored. So in exam, if they ask you to briefly explain the limitation of GDP, these are the answers over here. These are the things that have been ignored in the GDP. There are a lot of points. Choose the points that you are comfortable with and you are able to explain. Like for example, students' favorite point is the second one or the third one, for example. Like let's say they say that real GDP omits the health and life expectancy. Then you explain why. Because real GDP only looks into the value of goods and services, but not taking into account of the standard of living, not taking into account of the living environment and so on. Same thing like the second one, like GDP omits the undeclared economic activity. For example, people may be engaging in illegal activities, or people are evading from taxes, doing illegal stuff. They are not being recorded under GDP. Okay, so these are the points, okay, that you can use to explain the limitations. But make sure you can roughly explain a bit. Okay, so I put some keywords over there for you already so that you are able to explain if it comes out in your midterms. Okay. All right, now let's have a look into the tutorial question first before I move on to the next part. Now, question one over here, determine if the following components will be included in the calculation of GDP. Question number one, the purchase of a new car. Okay, new car by a consumer. You purchase a car. Yes, that is your consumption. So yes, that will be included in GDP under the consumption category. All right. Now, second, payment of social security benefits to retirees is like a pension funds or retirement funds. As I say, that's under the category of transfer payment. So the answer is no, it is not being included in the GDP, right? Because it is a transfer payment. Now, the third one, a company sells its existing inventory of goods and services to another business. So you see, existing inventory to another business. Okay, so is there any production of new goods and services over here? No, you are just transferring, okay? You are just transferring the existing inventory. So the answer is no, because in GDP, only the production of new goods and services contribute to GDP. And this is just about the transfer of existing goods between businesses. So it is not being included, all right? Question number 4, income earned by a citizen working abroad. So like, for example, you are Malaysian, you work in the UK, you work in the Singapore, so therefore, is it being included in GDP? It is still being included in GDP because you are still Malaysian. So you work in other country, you earn income. Okay, that is under the income approach. Remember, we said that when talk about income approach, that means we record all the incomes of our factors of production, which are land, labor, capital, and entrepreneurs. So you belong to Malaysians, you are Malaysian, so therefore, although you are not in Malaysia, you work in UK, you work in Singapore, you do have income. And that is also being recorded under the income approach. So yes, okay, it does contribute to GDP. It falls under the category of net factor income from abroad. Okay, that's what we call as income approach, one of the components under income approach. Okay, the next one, question 5, government's expenditure on national defense, like military. Okay, so yes, it is part of the GDP because that is about government spending. Okay, so therefore, yes, so the answer is yes. Okay, so that's the first part of the question. Okay, question 2, the type of question that you will come across in your midterm. Following are the components of the National Account Statistics of Malaysia in 2019. Please calculate the GDP using expenditure method and income method and value added method. Okay, all the components are mixed, so you need to choose carefully. So you see, this is the kind of question that you probably will be given, okay, in your midterm. Okay, so let's see the components first. You have changes in inventory and valuables. Okay, compensation of employees, that means the wages, exports of goods and services, government expenditure, gross fixed capital formation, okay, gross operating surplus, okay, imports of goods and services, private final consumption, taxes less subsidies on production and imports. Okay, so you are being given with all this info. So now they want you to use the different methods to calculate. Okay, so the first one, they want you to calculate expenditure approach. Okay, expenditure approach. So expenditure method or approach here, that means I use aggregate demand equals to C plus I plus G plus NX. I look into all these components from the above table to compute. So you see, just now we have consumption. Here, this is consumption. Okay. Government final consumption expenditure, government spending. So I put it over here. Gross fixed capital formation. Capital formation means like those are machineries, equipment, and technology. So that's under your investment. Okay, that's under investment. Okay, changes in inventories and valuables will be under this category as well. Okay, changes in inventory. That means like let's say there are changes in terms of the value of inventories or valuables. So it's under expenditure approach. Okay, then you need to have net exports. Now, net exports, how do you calculate net exports? You use exports minus imports. Okay, exports minus imports. So therefore, you have exports here, okay, and then you need to minus the imports. Okay, so you have all the values here, you total it up, then you will get the GDP at the market price. Try and see if the value is correct. Under this, we don't say a category, just like sometimes there will be changes in inventory, so we record under expenditure approach. Yeah, not specific category. So try and see the value correct or not. Remember imports minus, this one minus. Correct or not? Yeah. 737, right? The last three. Yeah. Okay, so answer is correct. Now, just now I haven't explained to you what is gross operating surplus here. Okay, I have put the short notes over here for you. Gross operating surplus means that the income earned by the business owners, entrepreneurs, self-employed people. Okay, it includes both incorporated and unincorporated business, rental income, okay, and interest income. So something to do with income. So remember, this gross operating surplus over here, we are referring to all the income. So later we may need to use the information later on. Okay, so let's have a look into second question. Second, they want to use income method. Okay, so therefore, income method over here, you add on all the income. Okay, so you can see one simple formula here. You take into account of the compensation of the employees, that means their wages, plus any gross operating surplus, and net indirect taxes. Now, what do you mean by net indirect taxes? Net indirect taxes means I use the taxes on the production, okay, minus subsidies. Okay, so that's what we call as net indirect taxes. Okay, so income method. Okay, so we take the information here. Okay, we have the compensation of the employees. Okay, we have the gross operating surplus, and this one, net indirect taxes. Okay, this is what we call as net indirect taxes. Okay, so let's see. Yeah, you use the three figures that we have found, okay, and add it up, you will get the same figure as well. About the same, right? Only one digit different, right? Here is 8. The last digit is 8, right? Just now is 7. But overall, about the same. You try and see if it's the same figures. Yeah, correct. So just need to remember the components under each approach. Okay, let's continue. Okay, for this question, they are not able to ask you to calculate output approach actually. So you have expenditure approach and also income approach. For output approach, you are not able to calculate because all these are about the total spending and also income. So there is no any total outputs for you to calculate. So for this one, you are not able to calculate the output approach. But I just want to show you how it works from this simple slide that you have. Okay. So the third one is value added or output approach. Although you are not able to calculate in this question, but I just show you how it works. So therefore here, what happened is we let's say we sum up the value added, okay, of the product. So you see there are different products over here: growing oranges, making orange juice, okay, distributing juice to the stores, selling juice to the consumer, okay. So you can see there is cost of inputs here and price of outputs. So you see we want to avoid double counting, so we must use the value added approach over here. Okay, so how leh? Okay, so therefore we see the difference. Okay, so we see the difference. For example, I use 1 minus 0, I get 1. Okay, so that's the value added because in between, I'm finding the value added part over here. Okay, same thing, 1.5 minus 1, get this one. Okay, this one minus this one, I get this one. Okay, and this one, these two difference, I get this amount. So see, once I have all these value added, okay, once I have all this value added, I'm able to calculate the amount. Okay, but this question you're not able to calculate because you're not being given with all this info. I'm just showing you how the value added works. So this one, I put it over here for you to read, for the value added part. Okay, so this is the question that shows you the calculations of the three approach. Now we look into the next one. Again, there are some formulas as well. Question 3. Using the above GDP figures and information below, calculate as indicated. So same thing, you are being given with net income from abroad, consumption of fixed capital, tax less subsidies, that means is your net indirect taxes, social security benefits, unemployment benefits, and accrue dividends. Okay. Okay, so now they ask you the first one, calculate national income. Okay, so how is the formula? Now, I want you to refer to this, the slides here. It is quite helpful for you to revise. There are a few formulas that you need to take note. That means you need to learn. Okay, so first of all, when we talk about GDP, the GDP that we have been calculating is at market price. Okay, GDP at market price. Okay, that means GDP at market price, okay, of the goods and services that consumers buying. So that's what we have been calculating so far. What if today I want to calculate GDP but at factor costs? Okay, at factor costs. Okay, that means I want to look into the factor price, which is the cost to the business or firms to employ the factors of production. So therefore, how? So therefore, I need to use the GDP at market price that I have just now minus this one, indirect tax minus subsidy. What is this? It's what we call as net indirect taxes. Okay, net indirect taxes. So GDP at market price minus net indirect taxes. Okay. Now, if today I want to calculate gross national product, okay, gross national product, bit different, national product at market price. Okay. So gross national product means what? That means I look into the total income earned by a nation's permanent residents. Okay, so here we look into the income here, not the market value of the goods and services, but the income earned by the people in the country. Okay, so that means how? That means I use the GDP earlier plus all the net factor income from abroad. Because here we start to look into income. That means it doesn't matter where you currently at, as long as you are working, so your income should be being recorded. So therefore, that is under gross national product. Oh, that means I start to look into the income that's being earned, although you are at overseas. Okay, so you use the GDP earlier plus net factor income abroad. Okay. Now, moving on. If today I want to calculate net, so a bit different, net national product, okay, at factor costs, okay, or sometimes they call it as national income. Okay, so let's say they want to calculate net national income. So how? So here we refer to the total income earned by a nation's residents in the production of goods and services. Again, it's about the income, right? The difference here is because we say net, the word net. So we need to minus out something. So you use the GNP just now. Here, just now, once we calculate here, we get GNP at market price, right? So you use this one, okay, minus depreciation. Okay. So you use these figures. Okay, minus depreciation and minus net indirect tax. Okay, that means indirect tax minus subsidies. Okay, remember when I say indirect tax minus subsidies, this part over here is what we call as net indirect taxes. Okay. Okay. Now next one, personal income. Personal income means income received by household. So here, the formula will be your net income that you calculated just now. So you see net income. Net income is what you have calculated just now. Okay. Net income plus income received not yet earned. That means you received the money already, but you have not earned that yet. And minus any income earned, but not yet received. Okay. So few components here. Now, just now, we say this one, accrue dividends means, okay, dividends that have been declared but not yet received. Okay, accrue dividends. You know that you will get the dividends, but you haven't received it yet. Okay, dividends that have been declared but not yet received. So you will not yet receive. Okay, so this is what we the example of income earned, you entitled for the dividends but not yet received. So you need to minus it. So that means this one, accrue dividends, later on you need to minus it. Okay. Okay. So that is for personal income. Now, when they ask you to calculate personal disposable income, means what? Means that you need to minus your personal income tax. Okay, you have to pay for taxes, the disposable income. Okay, now some tips that I want you to focus on. If today they ask you to calculate from domestic to national, let's say they ask you to convert from GDP to GNP. GDP is gross domestic product, okay? GNP is gross national product, okay? The one that we say just now, GNP. Now, if you need to convert like here, let me zoom in a bit. GDP to GNP, for example. So the tips is you must add net factor income from abroad. That means you take into account of the income that's being earned, regardless of where they are. If they ask you from market price change to factor cost, you subtract net indirect taxes. And how do you calculate net indirect taxes? You use taxes minus subsidies. Okay. If they ask you to calculate from gross to net, you subtract the depreciation. Some tips here that I want you to focus on. Okay, so I feel that this is the part that you will spend more time on revising, since you know that this is coming out in your midterm. They add this thing new to it. Last time didn't have. Yeah. Oh. Finance dot. Okay, so now we can start to see the question already. Okay, so you can see that. Okay, first one, they ask you to calculate national income. Okay, so national income is this one that I say just now. National income here. Okay, they want you to calculate national income at factor cost. Okay, factor cost. That means this one. Okay. Okay, that means this one. Okay, that formula, which is GNP minus depreciation minus this one, which is net indirect tax. Net indirect taxes. Okay, but you don't really have GNP right now. This one is they want to continue from the figure just now. Remember just now this figure that you got, this one. Okay, and this one. Okay, so assuming we take this one. Okay, so you need to use the GDP and market price just now to continue to calculate. Okay, so you see the info that you have is GDP, not even GNP, right? Okay, so you see we must have all this info. You see the one that I highlight in blue? You must have GNP and market price minus depreciation and then minus any net indirect taxes, right? But you don't even have GNP. You only have this GDP here. Okay, so I write here first. I say GDP at market price is how much? Okay, that's the GDP figures from what we have calculated just now. Okay, so now I need to convert. I need to convert this GDP into GNP. How? GDP convert to GNP, how? I want to convert into GNP at market price. So domestic change to national. So we add on what? Net factor income. Correct. Okay. So therefore, you can see that here. I write the formula here. Okay, GDP plus net factor income abroad. Okay, so this GDP plus the net factor income abroad. Remember the negative sign is there. That means you minus. You see a negative sign there. Okay, so that is for you to calculate the GNP. Okay, that means yeah. Right, that means they are making more losses because we are talking about income. So maybe the profits of like companies, maybe there are a lot of losses over there. So probably still negative. Yeah. So if I were to calculate, so the amount, if I want to calculate this one first, is like this. Okay. Now then depreciation. Okay, so depreciation, you have it from your data here. Okay, depreciation. Don't have. Oh, I think they want you to refer to up one here also. Depreciation. Is it here? They didn't give the depreciation. Oh yeah, sorry. So yeah, consumption of fixed capital. Yes, correct. Yeah. So depreciation you take from this one, consumption of fixed capital. Okay, so that's your depreciation. And they have already calculated for you taxes less subsidies is this amount. Okay, so you put that in. So this is depreciation. Okay, and this is the net indirect tax. Okay, then you have all the figures ready. Then you are able to calculate the national income. Okay, national income at factor cost. National income at factor cost. Right. You just take the figures on it. I think assuming she missed out the word million, there should be a million there. Yeah. The units on it. Yeah. So you take the figures. So the reason why we take consumption of fixed capital is like what you all say, like that means that it's about machineries, equipment, and technology. So since you use it, it will depreciate. So this is why we take that amount as our depreciation. You consume it. So you consume it means that it will depreciate. So therefore you take the figures. Okay, now move on to the second one. They ask you to calculate personal income. Okay, so the one that we learned just now, personal income, as you can see from the formula here, you use the national income plus income received not earned minus income earned but not received. So remember NNP here, also what we call as national income. So national income plus any received but not earned minus earned but not received. Okay, so three things here. So you have already had a figure just now. This one you have calculated just now, plus the received but not earned. Received but not earned means what? You receive the money, but it's not what you earn. So here you can see social security benefits and unemployment benefits here. These are what the money that you receive but not earn. Okay, so you see, I think it's written somewhere here as well. Income received but not earned includes transfer payments, such as social security benefits, unemployment benefits, and welfare payments. Okay, whereas income earned but not received means what? Earnings that corporates retain rather than pay to the shareholders in the form of dividends. That means dividends are not yet paid out. Okay, or even income that individuals have earned but not yet received within the accounting period. Okay, so therefore, when I say income received but not earned, that means we are taking into account of the transfer payments here. Okay, so therefore, we have the transfer payments here, which are social security benefits and unemployment benefits. Okay, so here 200 and 300. Okay, and minus this one, accrued dividends. Okay, minus accrued dividends. Okay, so you have these four figures. At the end, get this. Yeah, sure. Wow. Okay, let's continue. Wow. Okay. Let's look into the circular of flow of income. Okay. So, this part over here is what we call as circular flow of income. Now, last time in micro, you learned the two sector. Okay, let's zoom in two sector here. Okay. We look into the flow of income between household and the firms. Okay, so means what? Means, first of all, households, people like us, okay, we contribute ourselves, okay, or we contribute land, labor, capital, and entrepreneur, which we call as factor services to the firms. Okay, we contribute ourselves, we contribute our factor services to the firms, and therefore firms will pay us. Let's say we offer land, they pay us rental. We offer ourselves as labor, we get wages. We offer machineries, equipment, capital, then we get interest. And if we are entrepreneurs, we get profit. So therefore, firms, okay, will give us the factor payments, okay, in the form of rent, wages, interest, and profits. Okay, now once we have the money, we can buy goods and services, consumption, expenditure. We spend money on firms, and therefore we get goods and services. So that's the simple one. Two sector economy. That means you only look into households and firms. Okay, you look into the flow of income within these two. Okay, but is it realistic? No. Why? Because it excludes government, it excludes international trade. Okay, so therefore this is not realistic. This is why we want to have three sector and four sector. Okay, here you can see that we only look into household and firms, and in middle here there's financial market. Financial market means banks. Normal, we have banks. Okay, banks. So like for example, you as a household, you put saving in banks, and banks can borrow to the firms. At the same time, firms can also save their money in banks. So therefore, most importantly, right, in two sector, you only look into household and firms, two parties here. Although in between we have the banks. Banks do play a role. Okay, banks do play a role. But the problem is there's no government spending and international trade, not so realistic. So therefore, we want to look into third sector. Three sector. So three sector means there is government, the role of government is being included. So everything is still the same. You have household, you have banks, and you have firms. Okay. Yeah. So therefore, now what's difference here? You have government here. Okay. So the flow of income between the household and the firms remain the same. Okay, remain the same. It's just that now you have government. So how government play a role over here? First of all, they have government means what? Firms and households both they have to pay tax. Okay, so therefore household will have to pay for tax payments. Firms also have to pay for tax payments to the government. Okay, and government, okay, for household they will give transfer payments like unemployment benefits, financial assistance, pension funds. Okay, so that's what called transfer payments. So government will give transfer payments to the eligible households, and they will give subsidies to the firms. Okay, so you see it's two different things. One is given to household and another one is given to firms. Okay, so when government comes in, there will be this sort of financial assistance. Okay, at the same time, households can also work in the government sector. So if households offer themselves as the workers work in the government's sector or let's say households offer land to government, then government will also pay them as well in the form of factor payments. Okay. And government can buy goods and services from firms as well, payment of goods and services. So when government is involved, you can see the flow of income is a bit more already. Okay. At the same time, of course, government can save money in banks as usual, and banks can also borrow money or lend money to the government. Okay. So therefore, three sector over here, you have government spend, you have government, so therefore you have all this flow of income here. Okay. Again, is it realistic? Not really realistic yet because you don't have international trade. Okay, we need trade. Every country will have trade. So therefore, we see four sector. Okay, we see four sector. That means you start to take into account of trade. Okay, that means you look into net exports, exports minus imports. So same thing, you still have households, you still have firms, you still have government, but now you look into foreign sector as well, other countries. Yeah, and as usual, here is banks. Okay, so therefore, household can buy imports, right? They can buy imports overseas, and also, for firms, they can buy import as well. At the same time, they can export as well. So you can see there are import and exports on the right here. Okay, firms, they can pay money to buy imports. Okay, at the same time, they can also sell their product overseas and get the money because of their exports. So you can see there's this flow over here. Okay. Now, for households, sometimes they can work in overseas as well. Okay, they can work in overseas and send money back home. Okay, so therefore, if let's say you offer yourself as labor or you open a company in overseas, okay, you will get the income as well. Okay, so you have payment for factor and services. Okay, and sometimes you may get some financial assistance or aids from overseas. Then what we call as net transfer payments. So there could be net transfer payments coming in as well. So you can see here, this one, payment of factor income, okay, and also net transfer payments, okay. So when trade is being involved, apart from buying imports and exports, right, sometimes there could be other payments as well, like payment of factor services and also payment transfer payments may be coming in from other countries. Okay, so therefore, it's just to show you the flow of income over here when other countries are involved. Okay, so this is just to show you all the three sectors of the circular flow of income. Okay, so now, okay, first question here, in the circular flow of income, okay, households are the only source of saving. Is it true? No. Why? So yes, the other answer is no. Households are not the only source of saving because you can see here, firms can save in banks as well. Okay, firms can save in banks. And government, yes, correct. So therefore, it is false, okay, because firms and the government also can save, also can contribute to the saving. Okay, so that's the explanation. I put it over there for you to read. Now, in the closed economy depicted by the circular flow model, imports and exports are treated as leakage and injections respectively. Leakage means money going out. Injections means money coming in. Now, closed economy means what? Means true sector. That means no trade. Closed economy means no trade. Closed economy means no trade. Means what? Like true sector or tree sector. No trade. Okay, closed economy means no trade. So here they say that in a closed economy, import and exports are treated as leakage. Leakage means like your withdrawal, money flowing out. Okay, and injection means money coming in. So is it correct? It's not correct. Why? Because in a closed economy, right, there is no even import exports. So therefore, it's false because in a closed economy, import and exports are not even included. Okay, because there is no international trade. Okay, so it is not considered as leakage or injection. So far, so good. Now, I leave it to you for the last one, the mini homework as usual. Just like last week, I want you to try it out when you revise by yourself. But I just want you to see the table now. If I ask you, last question. Okay, you see this table, okay, they give you all this information. Let's say the first question, they ask you to calculate GDP. Okay, GDP. Before they ask you to go and calculate national income, personal income. Before they ask you to do that, let's say first question, they ask to calculate GDP based on this info. That means you have to use the three approach, either expenditure approach, income approach, or output approach. Can you tell me what approach you should use here to calculate GDP? Correct, lor? Income approach. Okay, so at least the first one you know how to do already. So question A, when they ask you to calculate GDP, you know that you have to use income approach. So that's what I say. In order to decide what approach you need to use, you need to see what data that you have been given. Like here, they give you all the income that's being earned by the factors of production. So therefore, you use income approach. Then from there, you get the GDP figures. Then only you can do the gross national product and national income. Again, remember the tips from GDP to GNP, domestic to national. So what's the tips? You add net factor income abroad. Very good. And then from GNP, change to national income. What you do? You minus, because it's national income, right? So you minus the depreciation, and one more is the net indirect taxes. Oh, you look so blur. Are you okay? So just remember, yeah, it's heavy because of all these formulas. Right? It's all these formulas. So we are just using back the same formulas on it. Try it out. When you revise, try this question out by yourself. Before you look into the answers at the bottom, you do look into the answers first. Okay, this extra question. Okay?